Using reverse mortgages to make IRAs better. And this is from Ed Slots, IRA advisor, even with my man Don Graves. Big fan of both these gentlemen. Big fan of Ed's been integral part of my career as a financial advisor. No one's more so than Bob Keebler. Bob Keebler out of Keebler and Associates out of Milwaukee, Wisconsin. Keebler, just fantastic. Hey, read up on Robert Keebler, like Keebler, you know, the chocolate factory, whatever it's called. But anyway, so this is from Ed Sly. It's interesting to see how Ed has gathered and appreciated the benefits of reverse mortgages. It's funny. It took a guy like Wade Pfau to kind of break through because Wade, you know, everyone, he's academic. He's an academic, right? And so once Wade kind of jumped onto the benefits of reverse mortgages, I think it kind of opened up. It's okay to tout the benefits of reverse mortgages as opposed to before Wade did it. Everyone's like, how no? It's kind of like permanent life insurance. No, it's evil. It's nuts. Anyway, there's a reverse mortgage for everybody. Just no, stop. I know there's some of you, you know who you are out there like, Josh is touting reverse mortgages again. I just don't get it. I don't get what the animosity towards reverse mortgages are. It's just weird to me. But, all right, so let's dive into this. My man, Don Grave, and I've referred people to Don. I don't get paid by Don. Don't get paid by Ed. Don't get paid any of this crap. I don't. So just FYI, this might be appropriate for you, or it might not. Buyer beware. But I'm a big fan of Don, and the people I've referred to him have emailed me back saying he's fantastic. So, all right, so we're going to talk right here. Seniors commonly have a large portion of their net worth in home equity. Data indicate that 87% of retirees own a home and 68% of the average retiree's net worth is in housing. Are you hearing this, my friends? 68% of the average retiree's net worth is in their housing. Not to consider this as part of your retirement plan just makes no flipping sense. Now, consider it doesn't mean you have to go forward with a reverse mortgage, but not to at least think about this, I don't understand. Tapping those dollars via reverse mortgage can mix well with other holdings, particularly retirement accounts. Yes. And we're going to get an example here. So right here, we got an example. We got you're 65 years old. You got a $500,000 home. I'm assuming this is paid off. I don't know what CMT market. I don't know what that is. So we're going to say your interest rate is 3.95%. You could take a line of credit of $224,000. Doesn't mean you have to tap into it. But that line of credit is growing at and my man Sergio is on here. You can correct me if I'm wrong here. But it's growing by whatever the interest rate is. So the loan is growing by whatever the interest rate is as the line of credit too. They're both growing together. So if you tap into a line of credit of $224,000 on a $500,000 home, you can have a line of credit that's growing in, again, my presumption is 3.925 each and every year. That's what's growing, tax-free. Which means by the time you're 70 years old, this line of credit would be worth, $280,000, which you could tap into for $1,400 a month as a tenure, over your life. Not 10-year, tenure. I wish they'd have it like just lifetime. $1,400 a month over your life, tax-free. Or you could take it for a 5-year term, $5,200 a month for those 5 years. That's $60,000 a year. 60 times 5, that's $300,000. Yes, you got to pay it back. You actually literally don't have to pay it back. The benefit of reverse mortgages is a non-recourse loan. So the bank secures your debt with a lien on your property. It's called a deed of trust. So a deed is when you own your house outright. A deed of trust is when you have a bank or other entity with a lien on your property. So the bank says, I got a deed of trust on your property of X amount of dollars. And when we are first dibs, when you either sell your property or you die in your property and your estate sells it, we get first dibs on getting that money back, just as an FYI. But let's just say that $500,000 home declines in value because MS-13 moved in next door for $450,000 a year because Sniffy Joe, because they're illegal, they got separated at the border, and now your freaking your property is valued at a third of what it was before. Doesn't matter. Non-recourse loan means the bank takes all the risk, and you're paying for that bank to have those risks by what's called MI, mortgage insurance. Trust me, you're paying for it. You're paying it through a fee through the reverse mortgage. That way the bank doesn't get left with the risk. It's actually the federal government who's guaranteeing this, by the way. So the federal government is guaranteeing that the bank gets paid, just like they do in my loan. I got VA mortgage. VA is Veterans Administration, is guaranteed by Ginnie Mae, exactly right. Which is you, taxpayer. All right, so you see how it works. You got 70, 65, you take a $224,000 on a credit. By the time you're 70, it's worth $280,000. You can take $1,415 a month for the rest of your life. It's $5,200 a month for the next 5 years, or you could do anything. You can do whatever you want. You can take as much. It's a line of credit, man, like your home equity line. All right. So we're going to use this for a correction problem. Some retirees rely heavily on their IRAs to pay for living expense, and more than a few of them skew their IRA holdings towards equity. There have been setbacks, including some of this century. Drawing down stocks during a bear market can be perilous. Wow, whoever thought of that? Crazy, right? We go George. Let's see. George has $1 million portfolio all in stocks, and he plans to withdraw 4% a year over the next 12 months. Suppose his equity fund fell by 50%, as they did from 2000 to 2002. If George maintains his planned withdrawals, he'll be taking an 8% distribution rate because he's withdrawn $40,000 from a portfolio that's only worth $500,000. Not only would that raise the risk of IRA depletion, it would decrease the amount he'd remain if the stocks were to rebound because he's pulling 8% of a portfolio that's dinged heavily, so the amount that's left has less ability to jump when the stocks come back. Now suppose that George had obtained a reverse mortgage structured as a $200,000 line of credit. He could tap that credit line for living expenses over many months tax-free while keeping his stock funds intact so they could, what? Come back! No matter which way the stock market moves, withdrawing heavily from IRAs and retirement may lead to shrinking and eventually potentially disappearing. What's more, sizable distributions may move seniors into higher tax brackets. Exactly. Some retirees would do well to monitor IRA withdrawals so that they fill up the low to moderate tax bracket. Yeah, I don't want to get in that. But all right, I do want to talk about here. Outmaneuvering the tax torpedo. Because believe it or not, there are many people who can get hit with a tax torpedo with Social Security. Tax torpedo refers to impact on seniors whose income is such they might owe little to no tax on Social Security, but when they choose to start taking their Social Security while also taking their IRAs down, they pay more tax. I'm telling you, for every $100 they pay, they receive in IRA distributions once they're on Social Security, it can increase their income by $185. It's nuts. That's a tax torpedo. It's freaking evil, man. So you pull $100 out of IRA to supplement your Social Security. Your income, your taxable income doesn't go up by $100. It goes by $185. That's a tax torpedo. All right. A line of credit on a home equity conversion mortgage, a reverse mortgage can make a big difference. An IRA might remain intact while the Social Security is claimed, while the reverse mortgage providing additional cash flow. Or low bracket IRA withdrawals might be combined with reverse mortgages to permit waiting for Social Security. 100%. And I could not agree more. So look, you're going to have to, just as any loan comes charges, reverse mortgages have fees. They might include the FHA mortgage insurance, loan origination fees, and various other fees. Exactly. The total will vary in place and from time to time. Often costs will add up to between $10,000 and $20,000. But they might be more, might be less. Is that worth it? I don't know. For you to figure that out. I think it's worth considering for sure.